As we prepare to close out 2024, our next guest believes 25 will be a year where many important and potentially competing factors will define the path of the Canadian economy. For more, we're joined by Kambiz Kazemi, CIO at Validus Risk Management, and he is here in studio. Thanks for coming in today.
Thanks for having me.
All right, so a number of things you want to discuss. Let's start with consumer debt and mortgages as well. So I just did some quick and dirty research before we came on. The last 6 quarters, Canadians' debt to disposable income has actually been declining, but still at a very high level, 173%. And you point out that there are a lot of variable rate mortgages renewing next year. So put those two things together for us. What are the ramifications of those?
Yeah, so, talking about 2025, I think the 3 things, to look at, one of them, very important, was leverage in the system. And as you pointed out, there's not only mortgages coming for renewal, but we look at a number of other indicators to see how the leverage is evolving in the system. One of the things that we have been looking at is bankruptcies for individuals. In Q3 of 2024, every single day, about 400 Canadians declared bankruptcy. That's quite high, is about 14% higher than the previous year, year over year. You look at the business side, it's been up 16% year over year, and is probably the 3rd highest level of business bankruptcy since 2009, just after the crisis. So for sure, there are signs that the leverage is, in the system cleaning itself out, which is a good thing. Those numbers, albeit they're high year over year, they're starting to, tame and be less quarter over quarter. So those are positive things. But 2025 mortgages are still coming for renewal, and a good part of them, because, in 2020 and 2021, rates were extremely low, as you might recall, variables. We did some in-depth work in that back a year and a half ago, and we talked about it here on this platform, and we said this is going to take time to work itself through the system. So the competing forces is that you're going to have in Q1 and Q2 these mortgages coming, and what's going to be very interesting, obviously the Bank of Canada is very cognizant of that. They have been aggressively cutting rates, another 50 bips just in December to help with that issue, indirectly probably. But aside from that, this is not something that's going to work itself in a matter of, months. So that's going to continue and is going to be there. That's an important consideration for the beginning of the year, and we think that, is going to play a big role. So that's on the leverage side of things. And then in addition to that, obviously, we have a lot of political uncertainty also at home here in Canada, in addition to what's going on south of the border. Just before the holidays, a week ago, the NDP mentioned that they probably would put a motion of non-confidence when the Parliament resumes. That's right, on January 22nd, if I'm not mistaken. Assuming they put that motion the first day, according to the rules, there's 37 to 51 days to have a new election. So that puts us at the earliest with the new government kind of mid-March to end of March. That's if everything goes like immediately. Mm-hmm. So that's an uncertainty in itself. Now, we do think that, a new government, which is probably at this point expected to be conservative, might be well received, and have some positive, I'd say, psychological impact on the markets and be helpful for risk assets. But the problem is, to enact policy, that takes a long time. So it's not, we might have that euphoria, but it's going to take time again for it to work into the system. So it's this competing effects between changes, cleansing of the system, and the time that's going to define things.
So hypothetically, let's say sometime in January, Prime Minister Trudeau says, you know what, I'm stepping down. And then there's an election after a Liberal leadership convention, perhaps. So from an asset point of view, would the markets generally perceive that positively compared to what's happening now?
Yes, probably there's going to be some positive sentiment and be constructive. But then again, for that to materialize into a sustainable positivity, you need a couple of things. You need policy to follow and work itself through. That's number one. You need the situation on the leverage and cleansing of the balance sheet of households and businesses to remain orderly. And the one risk there that is worth mentioning is unemployment. So as long as employment situation doesn't get worse, things could work quite well and go normal course. But the one element that we keep a very close eye on our side is the employment picture, because that's going to be defining. If you have debt to service and you don't have a job, life becomes complicated.
Right. Is the employment picture deteriorating meaningfully?
Right now, with the latest numbers, there is no sign of that, thankfully, that is meaningful. But it's definitely, it's hard to have a strong view one way or the other. It's something to watch closely. We had, a couple of months that were kind of optimistic, and then we had a little bit more pessimistic numbers. It seems that we're at the, mid-level kind of situation, so it's worth following.
Something else, Cam, that you point out globally is that you're seeing a desynchronization of countries, i.e. the U.S. is solid, EU and other areas of the world are not. And we're seeing a strong U.S. dollar. It's finishing off its best year since 2015, up 7.4% heading into today against a basket of currencies. So can you flesh that out for us a little bit, what you're seeing there, that desynchronization?
Yeah, so I think the strength that we have seen in the U.S. dollar in the last quarter is in part due to that desynchronization, in the sense that the U.S. economy has been particularly resilient. When you look at employment numbers, consumers spending, and generally there's some sectors that have a lot of hype and euphoria in the stock market. Like in addition to the big seven, the quantum computing and so on. So it surprised many, because the talk a year ago was whether we're going to have a soft landing or not. And here we are, talking about the economy that's holding. Now, what has happened, that's not the case in other jurisdictions. Canada, as we discussed at length, but also Europe, where things have been slowing down. Everybody has their own specific problems, obviously, the war in Ukraine and so on. And this difference has made that the expectation of rate cuts for the US have been pushed out. And as a result, you have this differential in rates that in part have contributed to the strength of US dollar, because you make more interest in having your money in US dollar. The real question remains where this differential is going to go next year. Is it the US that's going to see some slowdown potentially or not, or other jurisdictions are going to continue slowing down? For example, if Canada were to in fact not master the transition and unemployment gets worse, you could have a situation that difference widens, and you will see again a further weakening of Canadian dollar. So that would be potentially a risk.
Right. Sorry, just lastly here, Cam,
sure.
You've been talking about a lot of different factors, giving investors a lot to think about. Bring it back to the investor in terms of, okay, look out to 25. Here's how I'm positioned currently. Are there certain moves that maybe they should do in their portfolio or suggest to their advisor?
Yeah. So I mean, the most important thing is to. Not most important, but some of the things we look at the U.S. rates and see if at all there is any rate cuts being priced and the picture changes. At that point, I think anything that has with fixed income could start. U.S. fixed income could have quite a bit of upside. Essentially, longer duration bonds and even shorter term bills and so on. So that would be a big part of it. On the contrary, if you see again the unemployment in Canada weakening, then the Canadian dollar weakness is going to be a main theme. So it's important to have position yourself maybe by having some foreign exposure, particularly to the U.S. So those are kind of the main thematic on the very high level.
All right, very good. Well,